So, you're deep into preparing your consolidated financial statements. You've totally nailed AS21 for your subsidiary, you're feeling good, and then you see it, a 25% investment in another company, and suddenly your brain starts buzzing. What do I do with this? Is it AS13? Something else? Well, that's exactly what we're going to master today, Accounting Standard 23.
Okay, let's put on our exam hats for a second. You see this in a question, you're making a CFS, and there's a 30% investment sitting there. Now, what's your first instinct? For most of us, the word investment immediately makes us think of AS13, right? But hold on. In the world of consolidated accounts, is that knee-jerk reaction the right one? Let's dig in. And right here, this is it. This is the classic exam trap that costs students so many easy marks. In your own standalone books, your separate financial statements, you're absolutely right. You use AS13. But, and this is the whole point of today, when you're preparing the group accounts, the consolidated financial statements, using AS13 is just wrong. For CFS, you must use AS23 and something called the equity method. Getting this one distinction right is half the battle. Okay, first things first. Before we can even think about debit and credit, we have to know what we're dealing with. Correctly identifying an associate is the foundation for everything that follows. If you get this step wrong, all your calculations will be for nothing.
So what is an associate, really? Think of it this way. It's not a company you control, that's a subsidiary, and that's AS21 territory. And it's not a company where you share control with someone else, that's a joint venture. An associate is this special middle ground, defined by one key phrase, significant influence. You have a real say, a voice at the table, but you don't call all the shots. That term, significant influence, is everything. And how do we spot this significant influence? Well, the standard gives us a big, bright signpost to start with, the 20% rule. If you own 20% or more of the other company's voting power, we presume you have significant influence. Now, and this is important, it's a presumption, not a concrete law. It's just our starting point. Now, you have to pay really close attention to the wording here. It's the power to participate, not the power to control. See the difference? If you had control, it'd be a subsidiary. To participate means you're involved in the big decisions, the financial and operating policies. You can influence them, but you don't have the final word. And please, listen up, because this is a massive exam trap. So many students see the 20% rule and they just stop there. ICAI knows this, so they'll give you a problem where you only own, say, 15%. And you might think, not an associate. But then they'll casually mention that you have a representative on their board of directors. And bam, that is significant influence. These qualitative factors often matter more than the number, so always look beyond the percentage. Okay, so we've successfully identified our associate. We know what it is. Now for the big question. What do we actually do? How do we account for it? This brings us to the very heart of AS.
So what on earth is this equity method? The easiest way to think about it is like you're in a partnership. Your investment isn't just a static number that you record once and forget. No, it's a living thing. When your partner, the associate, makes a profit, your investment value goes up. When they make a loss, your investment value goes down. You are directly linking the value of your investment to their performance.
It sounds a bit complex, but it really just boils down to a simple 3-step dance. Step 1, record the investment at whatever it cost you. Easy enough. Step 2, on day 1, calculate if you paid a premium or got a bargain. That gives you goodwill or a capital reserve. And step 3, from that point on, you adjust the investment's value. Every time they report a profit, you increase your investment. Every time they report a loss or pay you a dividend, you decrease it. That's it.
All right, enough theory. Let's get our hands dirty and actually crunch some numbers because, let's be honest, in the exam hall, it's the calculations that will get you the marks. Let's walk through this simple example. Look, we paid $55,000 for our stake, but our share of the company's net assets on paper was only worth $44,000. So why did we pay an extra $11,000? That extra amount, that premium, is your goodwill. It's what you paid for their reputation, their brand, their future potential. And remember, if it was the other way around, if you'd paid less than $44,000, that difference would be a capital reserve. Now, here's the situation ICAI absolutely loves to test. What if you don't buy your entire stake in one go? Maybe you start by buying 10%. At that point, it's just a regular investment under AS13. But then, a few months later, you buy another 15%. Ding, 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 you've just crossed the 20% threshold, and now you have significant influence. This is called a step acquisition. So, how do you handle the calculation? Here's the golden rule. You calculate the goodwill for each purchase separately at the time of each purchase. So for that first 10% chunk you bought on April 1st, you do one goodwill calculation. Then when you buy the next 15% on October 1st, you do a completely separate goodwill calculation for that chunk. Your total goodwill for the CFS is then just the sum of the two. Okay, take a deep breath. We're now entering the tricky zone. This section on special rules and exceptions is where ICAI separates the students who've just memorized the basics from those who truly understand the standard. So pay close attention. Here's a classic twist. Let's say your investment has a carrying value of 1 lakh in your books. The associate has a terrible year, and your share of their loss comes out to be 2 lakhs. Uh-oh, what do you do now? Can your investment go to a negative 1 lakh on the balance sheet? And the answer is a hard stop. You hit the brakes. The investment's value is reduced down to 0, and that's it. Your investment cannot go negative. Think of 0 as an absolute floor. It can't go into the basement. You simply stop recognizing any further losses. But of course, there's always a catch. You'd only recognize losses beyond 0 if you have some other legal or constructive obligation, like you guaranteed the associate's loans. Now, what if they start making profits again? You can't just start increasing your investment value from day one. You first have to earn back all those losses you previously didn't recognize. So if you had an unrecognized loss of 1 lakh, you need to wait until your share of future profits covers that 1 lakh before you can start booking any profit for yourself. This is a very important rule. So, does the equity method go on forever? No. You stop using it if one of two main things happens. 1, you sell some shares and you no longer have significant influence. Or 2, the associate gets into so much trouble that it's operating under severe long-term restrictions. The moment either of those happens, you stop the equity method. From that day forward, the investment goes back to being treated under AS 13, and whatever its value was on that day becomes its new cost. Let's do a quick-fire round of a few more traps. First, different reporting dates. It's okay if your year-end and theirs don't match, but the gap can't be more than 6 months, and you have to adjust for any big events in between. Second, different accounting policies. The whole group should be consistent. If you use one method and they use another, you have to make adjustments to bring them in line. And third, a big one, unrealized profits. If you sold inventory to your associate at a profit and they are still holding it at year-end, that profit isn't really earned from a group perspective. You have to eliminate your share of it. We are on the home stretch. You've done all the heavy lifting with the calculations and the tricky rules. Now, let's just make sure you present everything perfectly so you don't lose any marks on the final step. Think of this as your final checklist to secure full marks. You must provide a list of your associates. You have to state your ownership percentage. In the balance sheet, this investment must be classified as a long-term investment. In the P&L, your share of the associate's profit or loss needs its own separate line item. And of course, you have to disclose anything unusual, like different reporting dates or accounting policies. Don't skip these. They are required.